Who's going to get most burned in this?
Well, I think there's an easy answer. Investors want growth, and the country that's moving most aggressively for growth, both fiscal and monetary policy, is Japan. Japan is the big winner, hands down. The big loser is Euro in the Europe. They're the odd man out. The ECB is going to be the least active of the major central banks, and therefore the euro is going to go up in value, and that's going to really hurt the exporters. So I would take the other side of Adam's Germany trade.
The cheap German trade, yeah, right.
Rich has been making the case for a better second half of the year in Europe. So what do you say in response to that? I mean, if they can't do enough on the currency front, how are the exporters ever going to export?
I certainly agree that the ECB is going to be the least aggressive of the central banks, although I think Draghi will do whatever it takes to save the euro, but that's probably not going to be of the nature of the QE we've seen in the Fed. I know my view on the euro is going to be driven as well by growth, as I mentioned, but I think there is a range within which you start to get a lot of jawboning out of European officials, and certainly if we got up to 140, we'd probably get a lot of jawboning, which we have already at 135. So I think the euro is probably in a range this year, as opposed to breaking out on either side.
All right, Alan, weigh in here.
Well, I think I heard Rich talking a little bit about the Italian elections, and the Italian elections have this tail risk, but I think it's not just a small tail risk, it's a large tail risk. Our guys are saying maybe even 30 to 40% chance of a hung parliament. So I think that would really push the euro down. And then I think the dollar's got a bit of momentum there. The dollar is looking very good against the yen, obviously, as we're talking about. Very good against sterling of late. It's looking pretty good against the Canada, the euro. Then pretty much it's everything.
In spite of the sequester, why is that? What's your interpretation?
Well, I think we've already sort of seen the fiscal cliff, and we navigated the fiscal cliff rather well. And I think we're kind of saying, okay, if we've got a little bit of additional fiscal drag, still the economy will probably grow and accelerate in the second half of the year as well. So, I think we've kind of dismissing to some extent the fiscal drag at this point.
I also think there's an interesting dichotomy opening up between the developed market currencies and the emerging market currencies. Developed markets clearly want to cheapen themselves, try to get some growth. The emerging market currencies and governments, I think, are going the other way. There's a big sea change going on away from a cheap currency to foster exports to a strong currency to foster imports. So I think you're actually going to see the emerging market currencies at the margin be a little bit more accepting of stronger currencies, because that also helps on the inflationary side, allows them to cut domestic interest rates and spur domestic growth.
Yeah, and they've certainly been doing that thus far.
Is this all about the emergence of a middle class? When you talk about these emerging countries wanting to have the ability to buy abroad, that's to supply their middle class.
Well, they have to, because look at the developed markets. They're not growing at all. We're growing. Last quarter, one of the reasons for all this currency talk all of a sudden is that Q4 2012 was the weakest quarter for global growth since the crisis in 2009. That's what's spurring all this. There's no growth. So the emerging market economies, they know they have to look internally now for growth. They can no longer depend on the U.S. consumer, the European, Southern European consumer.
Okay, so winners right here as we go across the globe. When we look at equity markets around the world, Japanese markets.
Japan's the best market in the world in 2013. Hedged.
Wow.
Currency market or equity market?
It's the best market, best equity market, and it's the worst currency market.
Right, yeah.
So you can go long the stocks and short the currency, and the big macro funds have already made some money on this. I think there's a lot more money to be made.
Rich, what do you say to that?
Yeah, I don't disagree. I think that Abe ran on a platform of reflating the economy. He will put in place people at the BOJ who will be committed to reflation, and reflation means money printing. They may not go out and directly intervene because that's politically combustible, but they'll do a lot of QE, which will weaken the yen from here.
You have a background at Treasury.
Yeah.
What do you think Treasury Department officials are saying about it and doing about this?
Well, Lael Brainerd, who's the senior official there, did make a statement supportive of Japan's efforts to reflate the economy.
Well, they all say that, right? They're all in support, because nobody seems to want to really take a direct aim, unless, of course,
and Chairman Bernanke as well. I think the tension among the G7 nations, the tension is, do you explicitly intervene? And probably that's a no-no, although Switzerland's doing a big time. They're not part of the G7. But I think Japan will have full steam ahead if they want to run a very aggressive QE policy.
And nobody's going to stop them.
Well, and certainly within the foreseeable range, I don't think they will be stopped. As long as it's QE and not purchasing foreign assets.
Of course, isn't this effectively what we did, right? I mean, Ben Bernanke, isn't this what we did?
Yeah. Well, and they're going a step further. And just to your point in terms of the Nikkei, if you start buying ETFs and the like, you actually got a direct influence on risky assets there. So I think, that's another particular play there.
Well, the other thing to keep in mind, too, is we can't just look at the yen move over the last couple of months. We have to go back to the crisis. The dollar yen was 125 at 2007. The yen strengthened all the way to 75, and now it's back to 90. It's not even halfway in between the range of where it was, which is why I think you can see continued yen weakness, significant yen weakness over the course of the rest of this year and into 2014.
So the Japanese want a weak yen, and they're getting it. The Swiss, they've got a very expensive Swiss franc. You've talked about negative deposit rates as trying to push that down. Can you explain that?
Well, you know, you can have the banks offer negative deposit rates effectively, or you drive the funding costs down to those kind of levels such that investors will say, wait a minute, I'm not prepared to actually put my money in a bank and earn a negative rate as such. And I think there is that kind of cutoff point where you might actually have a much sharper response where on the currency side, outflows, because you're offering investors effectively negative rates. There's a little bit of talk of that, of course, in the euro area as well. So it's not just Switzerland, and actually the talk on Switzerland's evaporated of late.
Amazing.
I got two more trades.
Okay, you got two more trades. We're out of time.
I'm
Give
not
us
done. I want to follow Adam.
Go.
Let's hear it. Let's hear it.
There's the long Japan equity trade, right? And I'd like to pair it with the short against German exporters, take the other side of that trade. There's also a long developed market equity trade versus emerging market equities. And then within emerging markets, there's a long local currency emerging market debt trade versus the equities. Three trades for you.